Have you ever wondered what stops a company from just, well, making up its financial numbers? It all comes down to a really powerful set of rules, the very foundation of financial trust. Today, we're going to break down exactly how it all works.
So, it all starts with this one absolutely crucial question. When you see a company report a big profit or loss, what's to stop them from just fudging the numbers to look good? That's what accounting regulation is all about.
You know, the best way to get your head around this is to think of business as a game. I mean, for any sport to be fair, right? You need three things: a clear rulebook everyone follows, referees to enforce those rules, and, of course, a shared philosophy of good sportsmanship. Financial reporting is exactly the same.
Okay, so let's kick off with why these rules are so critical. Just imagine a world without them for a second. It would be complete and utter financial chaos. One company's definition of profit would be totally different from another's, making it impossible for anyone, investors, lenders, to make a smart decision.
So what is this financial rulebook here in Australia? Well, it's not just a single book sitting on a shelf somewhere. It's actually a multi-layered system designed to make sure every business is speaking the same financial language.
And this slide lays out that hierarchy perfectly. See how it flows from the top down? It all starts with the law of the land, the Corporations Act. That law then legally mandates that companies have to follow the Australian accounting standards. Those standards are built on the principles of the conceptual framework. That's the core philosophy. And finally, if a company is listed on the stock exchange, there's one more layer, the ASX's own market rules.
But here's a key detail. Not every player on the field has to deal with the same level of scrutiny. The really detailed rules mainly apply to what we call reporting entities, and usually what makes you one is your size. And that's where this large company test comes in. If a private company hits at least two of these three benchmarks, we're talking over $50 million in revenue, $25 million in assets, or more than 100 employees, bam! It's legally required to prepare formal, audited financial reports. This isn't just a random line in the sand. It's about making sure the most economically significant companies are held to a higher standard of accountability.
All right, so we've got the rule book. But a rule book is pretty useless without referees to enforce it, right? So let's meet the key players, the financial regulators in the Australian system.
First up, you've got the FRC, the Financial Reporting Council. Think of these guys as the league commissioners. They don't make the day-to-day calls on the field, but they have the huge job of making sure the entire system, the rules, the refs, all of it, is actually working properly.
Next, we have the ASB, the Australian Accounting Standards Board. Now, these are the rulebook writers. They're the ones who create all the detailed standards that everyone has to follow. And, crucially, they make sure Australia's rules are in line with the global standards, what's known as the IFRS.
And finally, we get to ASIC, the Australian Securities and Investments Commission. This is the referee on the field, blowing the whistle. ASIC is the main corporate cop. They're actively watching companies, they're reviewing their financial reports, and they have the power to go after anyone who breaks the rules.
So we have the rules and we have the referees, but what's the spirit of the game? What's the core philosophy that drives all of this? That is where the conceptual framework comes into play.
The whole point of all this is captured perfectly in this one line. It's not about just crunching numbers for the sake of it. The ultimate goal is to provide information that is useful for people putting real money on the line, investors, lenders, creditors, so they can make good, informed decisions.
Now, to be useful, information needs two fundamental things. On one side, it has to be relevant. That means it can actually help you make predictions about a company's future. On the other side, it has to be a faithful representation of what really happened in the past, complete, neutral, and accurate. It's this beautiful balance between looking forward and looking back.
And to make that information even more powerful, there are these four enhancing qualities. Is it comparable? So you can actually line up two companies side by side. Is it verifiable? Meaning an independent expert could check the numbers and agree. Is it timely? So you're not looking at ancient history. And finally, is it understandable? So you don't need a PhD in finance just to figure it out.
So when you get right down to it, all of this useful information, everything from the balance sheet to the income statement, it's all built from just 5 fundamental building blocks. Let's quickly run through them.
First up, an asset. This is simply a resource the business controls that's expected to provide some kind of economic benefit in the future. It's what you have.
Second, a liability. This is basically a debt or an obligation to someone else. It represents what you owe.
Third is equity. And this one is simple. It's the owner's true stake in the company.
You just take the value of your assets, subtract all your liabilities, and what's left over? That's the equity.
And this right here, this is the fundamental accounting equation. It is the absolute bedrock of the balance sheet. What you have minus what you owe equals what you own. Every single business transaction has to keep this equation perfectly in balance. It's non-negotiable.
Now, the last two building blocks are all about measuring changes over time. First, you have income. This is any activity that causes the owner's equity to go up that isn't from the owners themselves putting more money in.
And on the flip side, we have expenses. You can probably guess this one. These are the costs of doing business that cause equity to go down. It's the value that flows out of the company to generate that income.
And that brings us to a final thought to chew on. We've got this incredible system of rules, referees, and a guiding philosophy. But as the business world changes, as companies deal more with digital assets, complex global supply chains, and new financial tools, how will these foundational rules of the game need to adapt to maintain that all-important trust for the future?